as we gear up for this business's most profitable season, tax season. Their most recent quarter just closed with high marks. Each metric that Wall Street cares about saw solid beats against expectations. America is entering its annual ritual of tabulating our collective income and graciously giving a portion of that income to our government. This business enters tax season poised to gain big from last year, and if any group stands to gain from tax season, it is the investors of Intuit. Welcome to the Quality Investor. Intuit saw phenomenal growth in this quarter. With the exception of ProTax, each segment grew. Intuit's largest segment, Global Business Solutions, which has QuickBooks, saw 19% growth. This segment accounts for 72% of Intuit's business and is a major focus area of growth going forward. Intuit emphasized the use of its AI models that leverage their massive data sets from small and mid-sized businesses to power insights and automate workflows for customers. Their AI offering aided Intuit in charging higher prices for both online and desktop QuickBooks software, attracting new customers and pushed customers to higher priced services. This demonstrates the wide economic moat I laid out in detail in my Intuit deep dive video. Check out the link below. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Higher prices reflect Intuit's strong market position. Businesses with strong brands have pricing power, and that helps drive margin growth, which you'll see soon. Intuit also embraced AI-powered tools early. This gave them a first mover's advantage, and Intuit can position its services that have AI as a premium in the market, also driving up prices. And by attracting new customers, Intuit continues to show strong demand for their premium products. Intuit yet again flexed their power level. Credit Karma saw 33% growth year to date. This was driven by increases in credit card, personal loan, and auto loan lead generation. Intuit derives revenue from users completing these loan issuances derived from qualified links, a broker fee, if you will. To me, this indicates the consumer's willingness to take on debt in a potentially teetering economy. Perhaps there is more consumer confidence than the headlines would indicate. But this is just the prelude to the upcoming quarter, which is where Intuit really earns its money. Tax season. I will personally be contributing to Intuit's bottom line in April, but it appears that Intuit is poised for a very good tax season. So let's quickly review Intuit's growth both in revenue and margins and find what Intuit's intrinsic value really is. Are they a good buy after this solid earnings? Intuit gained over 12% yesterday, closing at $625.51. You can see that huge spike upwards after they had a very good earnings report Tuesday night. And this was a much needed jump in the market. As you can see year to date, Intuit has just steadily been falling all year long. Now finally back to just about even for the year. However, on a one-year basis, Intuit is still down. The stock has certainly been out of favor by the market, but yesterday's earnings hopefully will jumpstart another run. So why is the market so happy with the Intuit results? Well, Intuit exceeds Q4 expectations. Quarterly revenue guidance slightly exceeds expectations, which is interesting to me because they actually just affirmed their fiscal year 2025 guidance. They didn't alter it in any way, but apparently the market was very pleased with this. Intuit announced better than expected revenue, with sales up 17% on the year to $3.96 billion. Guidance for next quarter's revenue was better than expected at $7.58 billion at the midpoint, 1% above analysts' estimates. Its GAAP profit of $1.67 per share was 98.1% analyst consensus estimates. So Intuit clearly blew away analyst expectations. Adjusted operating income came in at $1.26 billion versus a $999.6 million analyst estimate. And look at that margin, 38.1% margin, which is a beat of 26%. Intuit expanded their margins. As you see right here, operating margin 15% up from 10.9% in the same quarter of last year. And that free cash flow margin really shot up. Free cash flow margin was at 26.2%, up from 10% in the previous quarter. And here's another important metric for a subscription business like Intuit. Billings was at $4.1 billion for the quarter and was up 16.8% year over year. Billings is a non-GAAP metric that's often called cash revenue because it shows how much money the company has collected from customers in a certain period. This is different from revenue, which must be recognized in pieces over the length of a contract. Intuit's billings punched in at $4.1 billion, and over the last 4 quarters, its growth was solid as it averaged 15% year-on-year increases. This performance aligned with its total sales growth, indicating robust customer demand. The cash collected from customers also enhances liquidity and provides a solid foundation for the future investments and growth. And this chart really demonstrates how steady and reliable that billings growth has been since Q4 of 2018. Just about every single quarter has seen year-on-year growth. Intuit is a growth powerhouse. Consistent year-over-year growth in revenue, gross profit, and operating income. Over the last 10 years, their revenue has grown at 14.4% annually. And on a trailing 12 basis, they're already on track to have another stellar year. And we've seen very solid earnings growth and free cash flow growth. Earnings growth has been 12.8% annually in the last 10 years, and free cash flow has grown at 13.3% annually the last 10 years. And you can see that free cash flow growth down here in this chart. But what is most intriguing is its large pop on the trailing 12 basis. Trailing 12, their free cash flow is at $5.7 billion compared to 2024 of $4.7 billion. They're already $1 billion ahead 2 quarters in to this year. And that is because this quarter they had a massive free cash flow haul of over $1 billion. Intuit also has very good adjusted free cash flow, very good growth here as well, $13.12 per share on an adjusted free cash flow basis. They do have a lot of stock-based compensation. On a trailing 12 basis, that's at nearly $7 per share, and it comes in at 34% of free cash flow. I've mentioned before my feelings on stock-based compensation are mixed. I will say that while stock-based compensation does have dilutive effects, only a small percentage of that stock is generally realized, and Intuit also buys back a very large portion of its shares, offsetting any dilutive effects that stock-based compensation might have. You can see here that they had 284 million shares outstanding at the end of fiscal year 2024. Well, on a trailing 12 basis, they have 283 million shares outstanding. So their share count has actually fallen a bit, despite the large stock-based compensation. I quickly want to show some of the profitability metrics here. You can see the gross margin has fallen a bit over the last 10 years or so. Is now down to 78.97% from as high as 84%. Still a very good gross margin. But as I talked about in my Intuit deep dive analysis video, a large part of that was the Credit Karma acquisition, which we should start to see the returns of that over the next few years as that investment is fully integrated into Intuit's overall ecosystem. You can already see improvement in the operating margin since fiscal year 2022, now standing at 23.74%. And free cash flow margin has remained remarkably consistent. And since a low point of fiscal year 2016, we can see free cash flow conversion has slightly trended upwards, now standing at $1.87. So what are my growth estimates going forward for Intuit? Well, I didn't adjust them very much based on this earnings report. Their Q2 numbers came in remarkably in line with what I was projecting for my fiscal year 1. So I'm keeping my operating margin at 25.6% and a free cash flow conversion at $1.68. Intuit is a very seasonal business, and while their free cash flow conversion on a trailing 12 basis is very good at $1.87, they will have a better one next quarter after tax season. But typically their summer quarter is very, very bad. They usually have losses in that quarter. So it will pull all these numbers back down for Intuit by the end of the year. On a 10-year basis, I have operating margin at 23% on the bear case, 25% on the base, and 27% on the bull case. And with free cash flow conversion, I have that at $1.65 on the bear case, $1.68 on the base, and $1.70 on the bull case. Essentially, I'm keeping everything flat on a base case for Intuit going forward. The business itself expects double-digit growth long term for its global business solutions. So we can see a nearly 11% annual growth rate for the revenue segment for global business solutions in the bear, 12.9% on the base, and 14.9% on the bull case. And ultimately for total revenue, it's at 9% growth over the next 10 years on the bear case, 10.6 for the base and 12.3 for the bull case. For the base case, that's about half of what their 5-year compound annual growth rate for revenue has been. So coming down to the bottom here, we can see their trailing 12 free cash flow margin is at 33.15%. That would fall in between my base and bull year 10 free cash flow margin estimate. Bull case is at 35.76%. 31.7% for the base and 27.9% for the bear case. Free cash flow itself, I have growing at 9% on the bear case, 11.7% for the base, and 14.7% for the bull. So how does this all translate into a DCF price for Intuit? With the large pop yesterday, are they still a good buy? So now at $625.51 per share, they have a PE ratio of 58.3. Their forward PE is 50.6, which is actually right in the middle here of their 5 and 10-year average. Same with their trailing 12 PE ratio, a little closer to the 5-year average, but in between their 5 and 10-year average. My bear case discounted cash flow is at $538.74, $685.93 on the base, and $871.13 on the bull. Intuit pays a very good dividend, a very good growing dividend. My estimated growth rate for their dividend is about 13 to 15%, which is I have growing perpetually at 7.25% to 7.5%. They have an incredibly low free cash flow payout ratio at right around 20%. So they have a lot of room to grow that dividend. So on the bear case, I have their dividend discount at $632.35, $782.19 on the base, and $1,007.70 on the bull case. The exit multiple comes in at $813.11. I'm using comps of SAP, Salesforce, ServiceNow, and ADP. So even on the bear case, there's slight upside here, just under 1%. And on the bull case, about 42.4% upside. However, that's without a margin of safety. And so weighting all these together, we do get a buy price of $751.27 with no margin of safety. It's a forward PE of 60.8. For Intuit, I like to use a 20% margin of safety. They have ambitious growth plans internationally, so I see a little bit of risk there, despite the fact they're a very reliable growth machine. But with that 20% margin of safety, they have a buy price of $601.02 and a forward PE of 48.6. So with yesterday's pop, they're now a little bit too expensive for me. They're still well under that 10% margin of safety, depending on your risk preference. But I'm going to wait a little bit before I buy more into it until it comes back down under $600. And it very well could, given the broader market pullback, we could see it drag into it back down with it. We've already seen that in other stocks that have had very good earnings reports and have popped, but have since fallen with the broader pullback. Airbnb is a good example. But overall, I do believe my thesis is bearing out for Intuit, and it will continue to bear out in the long term. And I expect a lot of growth in this stock in the future. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.